We are happy to have Patricia Jacobs, an accountant with the Iowa Economic Development Authority, recording some information for us about financial reporting, and in particular focused on that end of fellowship reporting that we'll ask all of you to do. So I will turn it over to Patricia.
Thanks, Jamie. Um, I just kind of want to start out by giving you guys a real brief background of the types of work that I do for Volunteer Iowa. So I do everything from reviewing the claims and expenditures for accuracy and compliance with federal laws and state policies to preparing payroll allocations, which is to say how the employees allocate and or spread their time across the various grants that they work on. Um, I draw down the funds from the federal entities. And then I also do the reconciliations between our federal match and program income categories within each of the grants, and then prepare the support and reconcile the funds drawn and expensed for our federal financial reporting requirements. I also get the pleasure of doing the accounting work for IEDA's AmeriCorps grant. So I get to see some member payroll for that. I help process that. And then I also do the reviewing of the claims to make sure they're in compliance with the federal regulations. And I also get to do some budgeting, and then I give our program officers some tools and everything so that we can do a budget to actual comparison of those and see if we need to make any adjustments within our grant. So I know that that's a lot and a lot of accounting stuff, but I wanted to kind of give you guys a general idea of what an accountant that was working in federal grants would actually be doing for you, before we get into, okay, some of the basics that you need to set up before you get to kind of having an accountant actually do some grant work for you. So I'd like to start at the beginning and the very basics with accounting, and that is to say the chart of accounts. So the key to like good financial reporting and tracking is creating a solid method for organizing your financial transactions. So really your chart of accounts is your building blocks for this. And I kind of like to think of a chart of accounts as a digital filing system for each financial transaction. So when an organization kind of starts out, they're just going to need some basic items, but as they grow larger, they'll have more and more financial transactions, and that filing system will need to be able to grow with them. So as you think about creating your chart of accounts, you want to make sure that you allow some room in there so that it is adaptable as you grow as an organization. And so, okay, let's talk about the five main account elements for a chart of accounts. But also just want to say that these are really the five main accounting aspects that you really need to have a good understanding for what these things are. Um, so let's just go through them one by one. The first one would be assets, which is just in short what you own. Those are things like cash, real estate, investments, things like that. Then the second one is liabilities, which is essentially what you owe. So those are things like accounts payable, notes payable, essentially obligations that you have made where you will need to pay somebody money in the future. And then kind of the third one is net assets, which is essentially what you are worth. And so from a nonprofit standpoint, that would mean like your fund balances that you have to go forward to be able to spend money in the future for future um, opportunities. So those first three that you see there, you're going to see those again on your statement of financial position, or otherwise known as your balance sheet. Um, and we're going to talk about the balance sheet specifically a little bit later, but the next two items are often found on your statement of financial activities. And so, or otherwise known as your income statement. And those two things are income, which is what you receive. So that can be donations, grants, interest income. Anytime that you're receiving funds into your organization, they're going to come through your income. And then the last thing is expenses, which is what you pay. I think this is probably the most common thing that people realize, because this is the bills that come in the mail. This is your rent, this is your salaries, this is your utilities, travel expenses, things of that nature. And so now that we kind of have a little bit of a baseline for what those account elements are, I want to kind of walk through with you just a little bit about how you would begin to create a chart of accounts if your organization doesn't already have one, and or some things that if your organization already does have one, that you can maybe think about going forward for how you want to expand that chart of account to fit your growing organization. Okay, so what you see here is I kind of think of it as a tree, but we're going to kind of start at the top, and you can see that we've created some account numbers to go with these. And so you'll see the 1,000 is assets, 2,000 liabilities. I mean, those are those 5 basic elements. Again, I mean, at some place in your chart of accounts, you're going to need to break down your information into those 5 categories, because those 5 categories are the building blocks to what you're going to use to create your financial statements. So then, I mean, kind of, if you look at the next level where they have the rounded edge boxes, that is drilling down and giving additional detail. So, okay, so we have assets. Well, what does our assets consist of? The people that look at our financial statements are going to need a little bit more information, and just putting something into an asset account is not really descriptive enough for us to classify our financial transactions. So we're going to need to get more detailed. So I just pulled out a few categories here to give you guys some examples, but for assets, you could have, a checking account, savings account, accounts receivable. And you'll notice that I didn't per se number everything perfectly numerical. So it goes from 1,100 to 1,200 to 1,400. That was purposeful in the fact that I recognize that I'm going to grow and that I might want to put something else in that gap. So I am going to kind of create some gaps in my chart of accounts to give myself some room to grow. And then, I mean, and we just keep drilling down more and more, because we want to get to a place where we can specifically classify each financial transaction, and that it's going to give us enough detail that we're going to realize that, okay, all of our pledged donations are in the 1410 box, so that if somebody wants to know that information, they can kind of look, and it's not all mixed in together with our membership charges that we're doing or other things like that. So just understand that we're drilling down and getting more and more detailed as we go down, and so we can have some other subcategories and stuff like that. I mean, for example, you could have an expense category that would be travel, but you would probably want to drill that down even more into, say, a mileage and a lodging and maybe even a meals. So just think about that as you're thinking about what types of transactions you anticipate your organization having, as to what level of detail that you're going to need. So let's take a look next at some examples. This that I've pulled here, I've pulled it out of something called the Unified Chart of Account. It's something that California put together, and it's a pretty great document in the fact that it gives a lot of good examples. I specifically like this example because it really has some representation of what it would look like as you grew and got bigger, and how if you added certain elements, it would expand and you would have more accounts in your chart of accounts. So let's just talk about each one of these real quick. On the left, so level 1, you're going to see a really basic chart of accounts for an organization that is all volunteer and is cash basis. Let's just pause 1 second and talk about cash basis versus accrual. I'm not going to go into a ton of details, but I do want you guys to walk away with a little bit of an understanding between the difference between the two. And so cash basis is essentially thinking of it as money in hand. So you record an expense for cash basis when you take the money out of your pocket and give it to somebody else. So you no longer have that money in hand. It is an expense. Then again, when you record the revenue, if you're a cash basis, when you physically have the money in hand, or if it's in your bank account. So that's a cash basis. It's all about who has control of that cash. Where an accrual basis of accountant, you would recognize revenue when you earned it. So you might not have received the money yet, but you've already performed the service, or they've already pledged the money to your organization, something of that nature. And or like you have incurred a bill, but you haven't paid it yet. So it's okay. You can go ahead and mark it down in your books if it's in the mail. So that's kind of a very basic difference between the two. Before we go too much farther, because there is some accrual basis on there, and that is a decision that your organization will need to make, is if you want to be a cash basis organization or an accrual basis. It's not to say that you're completely stuck with one. If you get bigger and decide you want to change, it just does create some additional accounting work to transform from one method to another method. So, okay. Sorry for that little aside, but I think that was important to point out. So back to our example, you can see that in level 1, there's only 15 accounts that they have in their chart of accounts, so really pretty small. But in the middle, it's going to get a little bit more complicated. So you also have some salaries, and so that creates some different chart of accounts that you didn't have before. And then one of the other things that you'll see in level 2 that is not in level 1 that I just want to touch on real briefly is you start to see this concept of restricted or unrestricted. So unrestricted funds means that they came to you with no strings, versus a restricted funds, which means, hey, I'm going to give you $100,000, but you can only use it for interpretation services or something very specific. Like they give the money to you, but it comes with strings. They stipulate that you can only use it for certain things. So that's kind of the difference between unrestricted and restricted. And if once you start to get into that and they give you money that has strings attached on it, you now are obligated to track that money separately. And so you'll find some commonalities between that and federal grants, because if you receive federal grants, you are required to track the activity related to that federal grant separately from your general operations, as well as separately from other federal grants. You can't lump all your federal grants into one. And for AmeriCorps specifically, you have to track it on an AmeriCorps year by year. So you can't even put all of your AmeriCorps monies together, or you would have to put AmeriCorps year 1 money separate from AmeriCorps year 2 money. So as your organization gets bigger, you may see that there is some required separation of funds. And so there is some different tracking and stuff that you can do with that. And then just to kind of move forward into level 3, that's an accrual basis one, and you can see that there are some additional accounts that you would need if you had an accrual basis system. But one thing I want to point out is that every time you add something, you'll see how that chart of account number goes from 15 to 26 to 35. This is just, again, to reiterate that your chart of accounts is not just set at the very beginning. It should be adaptable and flexible, and it needs to move and grow with you as an organization. And so now that we've kind of talked about the chart of accounts, I want to get into some more of the actual financial reporting. And so we're gonna start with the income statement, and I say income statement, and you'll commonly hear this, and that's because I started my world out with for-profit accounting, and income statements are what are used in the for-profit accounting world. Nonprofits typically refer to an income statement as a statement of activities, and you will find that people use those terms kind of interchangeably a little bit. So if someone asks you for a copy of your income statement, they're really asking you for a statement of your activities as a nonprofit organization. So just kind of keep that terminology in mind when you're talking to people. And then one other thing that I want to really point out about the income statement and understanding it is that the income statement depicts your revenues and expenses, or your income and expenses, over a set period of time. So that's why you'll often say, oh, well, do you generate your financial statements monthly? Specifically, they're talking about your income statement. So they want to say, oh, okay, here's your income statement for the month of August or the month of September. And then a lot of people will generate them quarterly. So, oh, it's too much work for us to do it monthly. We do it on a quarterly basis. At the very least, your organization should be generating an income statement annually, at the very least. And so when you prepare your income statement, you do want to kind of give a little bit of context to the viewer so that they know what period your income statement is related to, because if you are giving a monthly one, it can be quite different than an annual one and stuff like that. So you need to tell your viewer what that period of time is. Okay, so we've talked a little bit about that. Let's go through how an income statement can be organized. So essentially, it's your revenues or your income minus your expenses gets you this change in net assets. And if you were living in a for-profit world, they would call that net income. But in a nonprofit world, they call it change in net assets. And so essentially what they're saying is you take and you add all your incoming funds together, and then you subtract out all of the costs that it took to operate and all your expenditures. And what that's going to give you is the funds that you now have available to continue operations into the next period. So, okay, so we kind of have our basic here for this, and I want to show you guys some really basic examples. I have a couple of them. This first one is an example that you could create in Excel. So if you're an organization that hasn't taken the next step and you don't have accounting software yet, you can still do financial statements. You can still prepare those, and you can even do it in Excel. I would encourage, as you grow, that you consider going to an accounting software system, because the number of transactions as you grow will just become so voluminous that doing it in Excel will be very difficult to do. And there are a lot of checks and balances and some internal types of controls that really ensure that your organization isn't making some inadvertent errors in your financials when you move into using a product like QuickBooks or any other type of accounting software system. So as you grow, think about making sure that your accounting system is growing with you so that you can handle, what your organization is getting ready to take care of. Sorry for that aside. I just want to make sure that you guys are aware of kind of what you should expect as you grow. And so one of the things that I want to point out about this specific one is then again at the bottom, you can see this change in net assets. So essentially, this company is bringing in more money than they are having going out the door. And so you say, oh, well, a nonprofit isn't necessarily supposed to be a profit. Well, not necessarily, but you still have to be able to bring enough money in the door to be able to cover future expenditures that your organization is going to have. So you want to make sure that you have that as a positive number or very close to zero, and otherwise it's like you're eating up your savings to continue operating. So keep that in mind. And then I want to show you another example. And this example I really like, because this is the first time that you've probably seen on an income statement where, or at least that we've seen, where it's having the unrestricted and the restricted. So remember, we talked about what those things were. Your viewer for your income statement a lot of times, or your statement of activities, is gonna want to see that information. And this is a really great time to point out that nothing that we have seen, are you seeing anything where it says the after school gala or whatever event that you have, you're not seeing those specific events anywhere in your chart of accounts or anywhere in your statement of activities type of thing. And that's because we don't per se want to keep all of our accounting records on an event by event basis. Okay, so that all being said, it's not to say that we don't ever have a need to track our activities and our financial statements by an event or something like that. I would just say that I would encourage you to do that in a manner where you're still keeping your basic elements of your income, your revenues, your expenses, and everything all lined up within that chart of accounts. So, okay, what does this mean? Well, let me give you an example of how IEDA structures theirs. So IEDA has a fund for Volunteer Iowa. And within that fund for Volunteer Iowa, we have different cost centers or subcategories for each grant that they are have at any one time. Okay, so then we even further break that grant out by the year that it is in. So think of it like a tree where you have the fund at the top, then you have those cost centers or those grants, and then you have the grant years. And then within each of those grant years, we have a budget that has all the revenues and all the expenditure categories together. So for each one of those, they're having a full almost income statement within each of those categories. So if you thought of it from our chart of accounts, sorry, I'm going to slip back here, that we had, it would almost be like it was landing right here above this 4, 5, 6,000, 7, 8, 9,000, the income expense categories, it would almost be a layer above that, where we would go in and add a fund right in there, and we could have a fund for each of our grants, so that we're still capturing all of that information that we need to, but at the same time, we can still see our income and our expenses in a nice statement of accounts. So one way to look at it from this slide is that, you would say, okay, I'm going to have grant 1, grant 2, grant 3, and those are all going to equal and add up to my unrestricted. Okay, so I could show an income statement that would have that level of detail, or I could take all those grants and I could add them up into unrestricted and just leave this as a column of unrestricted. So understand that your income statement can be combined and showed in different manners, as in different levels of detail. So that's something to kind of think about, but also to understand that you may need to pivot your organization and think about that as your organization grows. It's not to say that you can't go back in and add a layer in a higher manner on your chart of accounts. That's why we want to leave that wiggle room in there. Okay, so now that we kind of talked about the statement of activities, I want to show you guys the balance sheet, which in a nonprofit world is called the statement of financial position, or the statement of financial condition. And this is different from an income statement or a statement of activities in the fact that this is just a snapshot in time. So on December 31st, we go in and we take a snapshot of what we own, what we owe, what we're worth, all of those categories. And you can kind of see there on the right, the balance sheet is typically made up of one or two ways. And the first way is the more traditional accounting, I guess, formula that you may have seen if you ever took an accounting 101 class, where they say assets minus liabilities equals net assets in the context of a nonprofit. In the context of a for-profit, it would be net equity. So there is that. I think a lot of people present their financial statements more using the second formula that you have here, where it's assets equal liabilities plus net assets. Partially because nonprofits don't always have large amounts of net assets, or retained earnings types of stuff like that. So it's just a difference in presentation. So let's take a look at an example. And again, this first example is something that you could prepare in Excel. And what you could see with this example is it's not really that uncommon for your financial statement of financial position to be kind of small and not have a whole bunch of accounts. But what we're really looking at is seeing, okay, how much cash do we have? What are we going to have left after our obligations have been paid? So one of the things that you'll kind of see, this one has retained earnings, and it correlates back up here with our statement of activities. You see this change in net assets is 19,500. That's not really a coincidence down here that you see this 19,500 here. So that is kind of pulled from that. But I think this one's pretty simplified. I think this is more common. The second example is a more common way that you would see it if it was generated by a software. But you'll see that it's laid out the exact same, right? You have your assets that are going to equal your total liabilities and your net assets. They're adding those together. I chose this one as an example because I wanted to show you guys where we have this unrestricted and restricted down here in the net assets thing. And you also see like an unrestricted board designated. That can be that the funds are unrestricted, but you have to have board approval to use them. So there are some situations where you have that. Those are all things that your viewer is going to want to kind of see. And so I think we've talked really quickly about our statement of financial position, our statement of activities, and we went over the basic chart of accounts. And this is really the very basics of accounting. And I know I shared at the beginning all the other stuff that I do. And so I would like to encourage you that, again, as your organization expands, that you make sure that you're also expanding your accounting system to accommodate this. And part of that expansion would be making sure that you're finding an accounting person to assist you, whether that be somebody that's willing to donate their time and do some books and records and stuff like that for you, or whether that means that you need to go out and hire an accountant. And I would just encourage you to make sure that you are obtaining, especially if you're going to get a federal grant, that you're obtaining an accountant that is not just classifying your financial transactions into the appropriate chart of accounts account, but like as I stated at the beginning, that they're also looking at the expenses that you have and making sure that they are following the appropriate financial policies of your organization, as well as all of the federal regulations associated with it. So someone in your organization will need to be responsible for reviewing those to make sure that they are meeting all that requirements. And a lot of times that does fall onto your accountant. So make sure that you have somebody that is qualified to do that and understands that that's what's expected out of them with what they're doing. So with all of that being said, I just kind of want to turn it over to Jamie real quick and see if there are any questions that she has off the top of her head that maybe I could answer, and or we could talk about maybe the setting up a Q&A.
Yeah, thanks, Patricia. So just one thing that I think would be good to maybe make sure we clarify is in the written guidance that we gave to fellows about their final financial report, we said we would ask them to provide an income statement and a balance sheet. So maybe just so it's clear of the different things that you talked about today, how does that language correspond to what these examples that you gave?
Okay, and I'm going to flip back in the slides as I do this just to make it easy. So an income statement, I mean, if you don't have a computer software system, I would expect something like this. I mean, you can see that this has been generated out of Excel. So you need to provide some document that lists out the different types of income that you have and do a total income for a period of time, as well as the expenses. So they need to list those out. So, I mean, this one has fundraising expenses, management, and general expenses. I mean, I wouldn't be surprised if I saw rent, utilities, postage, things of those nature. It doesn't have to be something, super complicated, but some type of description of the type of basic operating type expenses that you are having. So those total income, those total expenses, and then we want to see the difference between the money that you're bringing in essentially and the expenses that you're coming out. A lot of times this information is obtained out of your checking account, okay? Because hopefully we're not paying for too many expenses in cash. And if we are getting cash, we're depositing that into the bank on a regular recurring periods of time. So we should start to see that stuff come through our checking account or our banking account. And so that's kind of where you could get some of this information. But it should be all of the income transactions that your organization has received, all of the expense transactions that your organization has paid out, and then the difference between those two. So that is a statement of activities, otherwise known as an income statement. And then from a balance sheet perspective, otherwise known as a statement of financial position or a statement of financial condition. I mean, this is an example right here that you could use to see that. And so cash would be literal cash that your organization has. I mean, one of the other asset categories could be checking accounts, savings account, things of that nature. And then you may not have any liabilities. If you don't have a loan and you don't have employees that you're paying, it's possible that you don't have any liabilities. Still, if you're in that situation, go ahead and list out liabilities. There just isn't going to be any categories where this accounts payable, loans payable is. Those would just be blank, and that wouldn't be anything in there. And so then your net assets would equal your assets. But it should come out in this format, right, guys? This would be the easiest, I guess, example of it for it. If you have QuickBooks, QuickBooks will generate a statement of financial position for you, and it will generate a statement of financial activities for you as well. Does that kind of cover what you were wanting, Jamie?
Yep, thanks. I just wanted to kind of cross-reference what we had in that guidance. And then, I think the other thing we just talked about is that we would be helping people as they were building their capacity to, keep their financial records according to different grants and programs. So I think you talked about that a little bit when you were talking about kind of how does IEDA separate out the AmeriCorps program.
Yeah, so I would just add that if you're doing your stuff in Excel, I would probably leave my common accounts as my rows, as in, like, from a row perspective, when I was setting it up, I maybe would have my different income categories, whether that's like donations, I can't even think, interest, different things like that, where you're going to have income. And then I would leave those other expense categories kind of there too, where, I have utilities, I have rent, I have travel, those things. And then maybe have, if you need to track it by an event, and or if you was tracking it by a grant and you were still using Excel, I would caution you against doing that if you're doing a grant. But if that's what you're doing, you're going to need to track it. I would make it as a separate column, so that you can still get all of your total revenues added together by summing your columns, but you would be able to break out the activity associated with that specific grant. Or if you want to track it by, like, is this fundraising event that we have profitable. I mean, from an Excel perspective, you could do it that way too. I definitely wouldn't say, I wouldn't want to chunk it together where here's all my activity or here's all my income from this event, plus here's my income from event number 2, plus my income from event number 3. I would be careful keeping those as completely separate things. I would want to present them all together. Does that make sense, Jamie?
Yeah, okay.
And if you have software like QuickBooks, you can do groupings and stuff like that to get those additional reports. It'll generate additional reports, like it would tell you all of your income and expenses for a certain grant based off how you set it up.
Okay. Right, well, I think that those were just things that I wanted to make sure we clarified. So thanks to Patricia. And as she said, I will, along with this recording, send out a time that Patricia will be available to have some live Q&A and respond to your questions. So thanks so much for sharing out, Patricia.
Thank you so much, Jamie.